Welcome to the Galileo Ventures podcast with me and
Hugh.
In real life this time. We are in cloudy Melbourne, if you can't see. And I'm down here with you talking to investors and founders and lots of other fun things. And we thought we'd better record episode 5. Can you believe it's episode 5?
It's gone so fast, James.
That's right, it has. Galileo Ventures podcast is the place to get your early stage news and unfiltered views from two seed VCs, namely us, and maybe in the future, guests as well. Today, we're going to cover OpenAI's Dev Day, the thing that's got the whole internet talking about AI. Not that we need to talk more about AI.
I don't think it was the thing, but anyway.
It was one of the things. We're going to go through a founder question that we mentioned last time, which is how to deal with valuation differences. And then we're going to review an AI pitch deck. So it is an AI themed podcast. We've never done that before.
There's no other AI themed podcast coming out at the moment, James. None.
Never. I haven't done a single one.
Truly a unique podcast, this is.
Truly original. But first, in 2013, a person called Sam Bankman-Fried, the founder of FTX, met another person called Will MacAskill in their university to talk about something called effective altruism. In particular, I bring it up now because back then, when Sam was still at university, he said, as a junior, he was wondering what to do with his life, and MacAskill had the answer. The best way for him to maximize good in the world would be to maximize his wealth. Now, fast forward today, and this is exactly what SBF has done. Unfortunately, in November 2, 2023, SBS was convicted of fraud and conspiracy on all 7 counts for stealing customer funds in the FTX debacle. Right.
Sure.
Now, everyone's heard about the FTX debacle. We don't need to go into the actual conviction. What I wanted to ask you here was there's been 2 books written about it so far.
Yep.
Michael Lewis, Going Infinite, is the one that everyone's been talking about. There's another one, which I wanted to ask you about. What do you make of the SBF saga?
Yeah, so Zeke Foe is the Bloomberg columnist who wrote Number Go Up, which is the book that I read. And that's a book more broadly about kind of the crypto ecosystem and things like that, and sort of touches on and focuses on, I guess, the SBF story as a sort of telling, factor for perhaps what the rest of the actual sector might be looking like.
Yeah.
Michael Lewis's Going Infinite is a little bit more of it's I guess been critiqued, I guess, as a bit more of a puff piece. A little bit more in that realm of sort of like the Walter Isaacson biography of Steve Jobs kind of sense of, quite sort of lionizing him to some degree, even though obviously highlighting the not insubstantive flaws.
Yep.
I think more broadly on the saga though, like we have this thing of like, there's this, and I think, again, one of my favorite columnists, Matt Levine, has this interesting concept of like, what is the optimum amount of fraud for a business? Right?
Yeah.
And particularly in financial services.
Yep.
Because if you do no fraud whatsoever, you're probably not taking enough risks. But then you can do too much fraud, right? And he gives actually an interesting example recently about this is going to get in a really weird area, one of the Mexican cartels. And the Sinaloa cartel decided they were going to pull out of fentanyl distribution in the US.
Okay.
Right? And he describes it as that being the moment where they go, oh, okay, too much, right? There's too much crime in the business. We want to dial crime back a little bit, because if you have too much crime, you're going to like draw the attention of the wrong people. You want to have just the right amount of crime.
Okay.
And even obviously the cartels have this same balance of, you don't want to sort of become the piece. And so I think there's like this early sort of like, messy days of every company. And I think, yes, while you would hope that a financial services exchange is much more official and everything else, like the reality is this is cryptocurrency, right? We all know it was like cowboys and, the wild west for a while.
No regulation.
And so there was a degree of just like chaos, shoot from the hip, pretty like messy. That looking back on it, you go, wrong.
Yeah.
But at the same time, like there is an acceptable amount of that. And particularly in the early days when you are trying to often, not necessarily, again, like we sort of go back to the Elizabeth Holmes type saga of like, what is, fraud?
Sure.
And how much of it is this piece of you saying, oh, well, this is what the case is, when as a founder, you're perhaps, not necessarily lying. You're not lying, to be clear.
Sure.
Or committing fraud. But like, you're focusing on the good parts about the business.
Yeah.
And, underselling the bad parts of the business.
It sounds like you're going to side with Michael Lewis here, that maybe he's not as guilty as
charged.
I mean,
look, I think the other side is, the fact that he tried to like run the gamut of letting this go to trial, I think, is a bit of a questionable one.
Sure.
But everyone has a different strategy, I guess, in that sense. But I think, to be clear, like, totally fucked it up, right?
Yeah.
Like, totally stuffed it up. Spent money that wasn't his.
Yeah,
right?
correct.
And it's like, lesson one of running a financial services industry, business is don't spend money that's not yours,
And
particularly if it's held, as customer custody accounts on an exchange.
And hilariously, the phrase, the sentence I was quoting before, was from Sequoia's own website, which was a profile that's now been deleted of SBF, which I'll link in the show notes because it's very interesting in the web archive to read. And they open with Alameda Research.
Yeah.
And it's like incredible thing that he's
again,
done.
like, Matt Levine's done the whole analysis of the piece of like, ultimately it was an options trading exchange.
Correct.
Right? And it's not new that in options trading exchanges, sometimes they blow up.
Yeah.
And there's a history of this sort of thing happening. The problem here was, and I think that the part where you would say there's, quote unquote fraud, is that while Sam Bankman-Fried was walking around saying, hey, we've got these, robust risk management systems, we've got algorithms, we've got, stops and everything else, they'd just sort of like set a Boolean internally in the system that just said, this affiliated firm can just ignore all of their internal risk controls, right?
Yeah.
And for a financial services firm, that's bad, right? It's clearly bad.
Yeah. Yeah.
And you can't really sort of step back of saying, did something dodgy go on there? Like, obviously something went dodgy on. Like,
yeah, correct.
You can't walk around and be like, oh yes, look, we have these great, robust financial systems to avoid our options traders from just like zeroing out the entire exchange and all of its customers.
Sure.
And then exclude one that happens to be run by your, at the time, romantic partner.
Yep.
Like,
just to make things even more complicated.
It's got to look bad.
Yeah. And it didn't help that he shared the whole saga on social media. Yeah. So there were numerous times during the court case where they asked him a question, he says he doesn't remember, and they just show a screenshot of his Instagram or what have you. Look, I think it's going to be, I'm very excited to read both books. It's on my list for this summer in Australia coming up. I guess just to bring it back to our podcast audience, what are the important lessons in your view for the founders who are listening in?
So, I mean, I think in one sense, and I guess the other piece is the WeWork bankruptcy.
That's right. In fact, I didn't mention that.
Similar piece of sort of that sort of founded reality distortion matrix, and
which we've talked
true
about
belief
before.
in what the outcome was.
Yeah.
Like, I think the bad lesson to take out of this is don't take risk.
Correct. I agree with that.
I think that's the bad lesson. And I think the anti-lesson here is that you shouldn't take risk. I think that the key part here is like, you've got to set the risk reward right. And that's what startups are all about. It's about taking risk, but it's about taking risk in the right places to generate the right outcomes. And that outcome isn't just like kind of a binary flip of a coin, probability level of like either trillionaire or nothing. Like, that's not necessarily a rational decision. And I think obviously the risk management piece here all went wrong, and perhaps there weren't some controls that should have been in place in terms of the board or from independent directors or auditors, and like to be able to actually make sure that was appropriate, particularly of a firm of that size. And obviously those things improve as they go. But like, I think the lesson not to take is not to take a risk. But I think the other lesson is that there was obviously a whole lot of stuff in this space of where VCs didn't do their diligence, didn't do their probity. Auditors obviously didn't do adequate work here.
Yep.
Like, we rely on a number of these different systems and kind of, Swiss cheese model of like, we rely on a number of different overlapping systems to try and avoid this kind of situation happening.
Yeah.
And obviously there was a multi-systemic failure.
Yeah. Yeah, that's right.
And that part I think isn't necessarily an SBF.
No, I think that you can't just blame it to him. I mean, if you think about the amount of investor money lost just investing into the company.
Yeah.
Well, no one seemed to have any controls. And Sequoia was one of the main backers. Famously, they've come under a lot of flack because of lack of diligence, which for other VCs was astounding.
But I mean, at the same time, that was what you did at that time in crypto. Right?
Sure.
It was a massively growing exchange that was just like exploding in volume.
And you know what? Some of these investors have made a lot of money. I know of one other famous fund that's done 17x cash return.
Yeah. You sell out. It's the same. Again, the WeWork story is the same. If you sold out at the right time of WeWork as a VC investor,
the founder did.
It was still and it was still a great investment. Like, in terms of your responsibility to LPs of your fund of returning money to them, if you sold out a WeWork at the right time as a VC investor, you nailed that investment.
Yeah,
great investment.
Yeah,
was it a good investment for the broader public, and was it right value? Was it valued for the right amount of the long term? Obviously not. Like,
Yeah, that's right.
it's just gone into bankruptcy. Like they were going to IPO at 96 billion and now it's bankrupt. So like, obviously not. But the nature of public markets is that there's a degree of this of like the value of the company is this sort of shared delusional, but like this shared delusion of belief of what the future might look like.
Yep.
And if you sell at the right time, you've done your job.
I would love to know what other people's views are on this. If you've read either book, please send us your comments. In Spotify, there's a little point where you can leave your view. There is. So on the podcast episode, you'll see that. So please leave a view. Would love your takes. Let us know what you think of the books as well. Moving on, we are going to talk about one piece of global news. And in particular, last week, OpenAI held their first keynote, which they called a Dev Day, but it was kind of like an Apple-esque keynote with the founder, Sam Altman, on stage. Another Sam. Less fraudulent Sam.
Less fraudulent Sam.
In particular, they announced some key points. One of the key points was they've hit 100 million weekly active users, which is incredible for a product that's less than 2 years old. They announced GPT-4 Turbo, which is 3x cheaper on the input tokens, 2x cheaper on the output tokens, a bunch of other functionality. So it's a great extension on their existing model, which is GPT-4. They've built their own GPT, which is the part that I'm very interested in. And they've also created an app store for GPTs. And they've also then done some stuff around text-to-speech APIs, which allows you to kind of use it like a Siri that actually does real stuff.
Yeah, and that was a really interesting one where it was like there was someone had two phones next to
That's right.
Yeah, TikTok.
That's right. Yeah, we'll link in the show notes. There's a TikTok. It was very, very cool. Regardless, it was a lot of people talking about it. In my VC WhatsApp chats, they're all talking about it. I guess
you're among the best WhatsApp chats, James.
I'm in some great WhatsApp chats. What questions do you have for me about this?
Yeah, so I guess like in that world, and we've obviously, everyone knows now who OpenAI is. What do you think was kind of the most interesting takeaways? Like stuff like GPT-4 Turbo, so like, yeah, it's kind of it's an iterative thing that might enable some new business models, because it's cheaper and faster than it was in the past, whatever, but like that's sort of stuff at the margin. But like, what were kind of the big hulky things that you think people needed to know coming out of that? And what do you think that's going to mean for startups in the space? Obviously knowing there's a million AI startups in the space, kind of having a bit more of a look under what really the strategy might look like for OpenAI in the long term.
Well, I think the first thing is there was no surprises in that announcement. The main takeaway for a lot of devs who cheered in the room was the fact that the API is now a lot cheaper. Now, what does that mean for startups? Well, it's not faster. That's the important part. It's just cheaper. So they're going for price over speed right now.
But I mean, cheaper isn't going to, that was always going to happen over the long run.
Sure, it was. Well, but now the question becomes how much money they're losing. Is this unprofitable? Are they in territory where they're just going after adoption, which to me makes sense. I think that I understand that because really there's no winner right now. For me personally, what I think is really interesting, and this is partly because we've invested in this space now, is the GPTs were, again, that was leaked beforehand, but the GPTs were an interesting one where you can create your own chat style GPT, whether it's for writing assistance, whether it's for homework studying, whether it's for VC research, which is already, I saw someone released a GPT for VCs. So you can upload pitch decks and get it to review.
You just see all the things about how people have asked the new model to give it the data that it's been trained on, and it just sends you the link to the spreadsheet.
Yeah, that's right. Yeah. There's actually a lot of very interesting examples. I follow a particular research that tries all sorts of examples every day, day in and out. One of the most interesting ones is when it says it can't do something, just keep asking it, and often it will try and learn or work out what it can't do, and then it'll spit out some other output. It's very fascinating. Pushing some of those fascinating research experiments aside, like in the end, when you're making a product, you need to be robust.
Yeah.
The GPTs are very simple. They are not that customizable. You can't really train it on your own data, so it's using RAG, some version of RAG. And I think it's really what I would call the first entry point to creating your own custom GPTs. Now, of course, GPTs to us as investors and people in the ecosystem, that is another word for agents. And so for those who aren't familiar with agents, agents are essentially apps, AI apps that can go out and do work and do tasks for you. And you can kind of think of them as a lot of different tools, AI tools, chained together that can go and create things and research things and come back to you and report results. So I think the fact that you can create a GPT, then put it on an app store, and they may pay those creators is, to me, very, very intriguing.
It's also incinerated a lot of businesses.
Yeah, well, yes and no. So I think it's complicated. I don't know. I think there's a lot of light wrappers which just don't make sense, right?
Yeah.
There's a lot of light wrappers where it's like, create me a pitch deck, and it's like, well, GPTs can now do that.
Yeah,
it's to some form. But the reality is, and the question I still have here is OpenAI becoming a consumer business, aka Apple App Store, or is it still becoming an enterprise business? And I'm not sure what Dev Day really showed me. It showed me that it wants to be both.
Interesting question.
And for those that are following along,
with enough money, you can be both.
That is true.
With limited money, you can't.
That is true. But, even if I think back through examples of big companies like Apple, I don't think Apple is an enterprise company first.
Yeah, maybe.
I mean, they went after prosumers, right? We'll call them prosumers in some form. But without going into too much into the history, right? I thought it was just interesting that there was they're doing.
It wasn't clearly both. Yeah, it wasn't clearly one or the other.
Yeah, correct. They're doing both, and I think that's fascinating. Now, for us, we, as I said, I've got a blog post coming out about agents soon. We think agents is fascinating, and I think the fact that OpenAI is going down this pathway is really reaffirming to some of our thesis, which is agents are going to be really integral in the sort of AI workforce, as one of our portfolio companies is calling it. And so that's kind of my take. The text-to-speech stuff is very cool. I'm going to be playing around with that later this week. And I'm
reminds you Microsoft Sam.
Yeah, that's right. And you know what? It was fascinating to watch, and so I'm keen to see what happens in the next Dev Day next year.
Sure, sounds good.
Okay, moving on. We are going to go to founder question. Now, this founder question has come up 3 or 4 times.
Yep.
I really wanted to spend some time talking about it. This one in particular is how to deal with valuation differences in Australia versus USA. To set some context, obviously valuations in Australia, one of the biggest gripes founders tell us is valuations are lower for the same type of company than in the US.
Yep.
And we hear this a lot.
Valuations are lower and round sizes are lower.
Correct. And so let's just go through an example. So there's the common example is, hey, I'm raising for my company. We hear this all the time. This company out of YC just raised as well, doing the exact same thing, except that their valuation is 15 to 20 million USD, right?
Yep.
Which is somewhere between 15 to 30 million Oz.
Yep.
Now, for a pre-seed seed-stage company, I don't care who you are, that is nuts. That's a banana valuation, right?
Depends on what stage is that.
Well, even if
seed has different meanings to different people, I guess, is my
sure, but even for early stage, it's a banana valuation. But it is YC, it's XYC, and so they often benchmark against that, right? And to give the audience an example, like the latest YC guidance, I've been told, for the current batch, which is raising money, is between 15 million to 20 million val caps because they raise on safe notes, convertible note. Now, how should a founder think about this?
Yeah, I mean, look, I think comparable companies are important, right? Because obviously they're the people you're competing with as well. So that piece is important. And I think if you go, this company just raised 600 million and they're at the same stage as us and we're raising 2, I'll go, okay, there's something a bit wrong there.
Sure,
but certainly I'm worried that this other company is going to.
But let's just assume they're both early stage, right? Very early revenue, if not any revenue at all.
And but I think the hard part for me is then to go, well, okay, so what is it? What drives that difference? And I think, like I said, for me and my observation is that the round size is higher and the valuation is higher, right? And the rule of thumb that I always say to founders is you take the money that you're going to need in the next 12 to 18 months, that equals 15% dilution plus or minus 5%. That gives you your valuation range. Now, in the US, typically, San Francisco, blah, 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 a software engineer is really expensive.
Yep.
And most of your costs early on are software engineers.
Yep.
In Australia, software engineers are not nearly as expensive.
Sure.
You also have things like the R&D tax scheme and things like that makes software engineers cheaper, realistically.
Yep.
And so as a result, your dollar goes a lot further.
Mm-hmm.
And there is actually this sort of I guess labor arbitrage in a sense of in Australia, that capital requirement for 12 to 18 months is often lower for the same size team doing the same work.
That's right, it is.
In a place like San Francisco.
That's right.
Because the cost of engineers, particularly in the And even when Sydney, even Sydney engineers that are very expensive.
Yeah.
So for me, it's sort of like, well, that of course that has to then drive a difference in valuation.
Yeah.
Because we don't want to say, well, valuations should be universal, and therefore, if you're in San Francisco, you should have a 40% dilution. Like that doesn't make sense.
Yeah.
But equally, if you're in Australia, like, what do? Either you could raise less at the same valuation, and be able to then go, well, okay, that's how we're going to do it. You can try and raise exclusively from the US, but then say we're going to put all of our team in Australia. It's a bit like saying you're raising in Australia and you're saying I'm going to put all of our team in the Philippines, or I'm going to put all our team in BPO or whatever, some other Asian nation where that labor arbitrage is obviously similar dynamic, but it doesn't really work in that early stage. And it just doesn't really make sense.
No, it doesn't.
And so really as a founder, it's like you've got to start with what you're really going to do. And I think if you're going to start, particularly if you start at day zero and you raise from US VCs, you're probably not then going to be able to raise from an Australian VC afterwards.
Yeah.
Because the comparison and everything else that the Australian VC is going to look at and the way that you're going to have spent money, like let's say you've then spent 3 years worth of money because you've raised a US round, you're paying Australian salaries, you spent 3 years worth of stuff, and you go, okay, now I'm going to go and raise my A. An Australian VC might go, well, you spent 3 years. What have you done? And you better hope you've gone a really long way on that 3 years to be able to then persuade someone to pay, an American price, so to say, an American price later on.
Yeah, that's right. That's right.
Or you can keep, if you can successfully, and some founders do, I guess, some founders raise early from the US and keep raising from the US. And that's also a totally valid strategy.
And we've seen that before, but it's rare.
It is rare.
It is rare. Basically, if you go through YC, you can raise from the US early.
Well,
but you usually have to flip up the company as well.
Again, but I think the reality is like it's different ways of building a business. And over time, those things kind of converge again. I think that's what gets interesting is like as you get to, late stage Atlassian type size, those valuations sort of reconverge.
Of course.
But that's also because you have global teams by that point.
That's right. That's
and
right.
all of your other competitors also have global teams.
That's right.
And so that difference in sort of like cost of labor and cost of capital and cost of, like suddenly you're spending more on advertising and things like that, which again is a bit more of a like universal expense than is necessarily a uniquely geographic.
Yeah.
And so I think that's where, for me, I think that's the difference. And again, as a founder, you can look at it on the face of it and go, oh, well, like valuation here is bigger. Sure. But I mean, the other piece is this is, like valuations is a market-driven thing.
Yeah, that's right. And you don't live in San Francisco, you live in Sydney or Melbourne.
60 million valuation and you can get a $10 million valuation, I'm not going to say to you, you're crazy for not taking the 10.
Yeah, sure.
Like,
yeah.
Don't get me wrong.
Yeah.
I can see the rationality, but I just think that like for the number of people that seem to think that it is one versus the other, you sort of go, okay, well, like get both of the options.
Correct, yeah. I think my view on this, so I guess I have a slightly different advice to founders. I think what you said is good. What you need does dictate, how much you need does dictate how much your valuation is going to be. But my advice to founders who get really caught up on this, because we hear a lot, the feedback. Australian VCs are the worst in the world. They don't give the valuation of some frothy YC company. Really, come on. But my advice is the valuation doesn't actually matter. The valuation does not matter. What matters is how much money are you raising and can you raise that money? And then the secondary is, okay, what's your dilution? AKA, what is your valuation? And in SF, to run a company in person in an office just costs so much more than to do the same thing in Melbourne, right? And so if you don't need to raise $3 million to do the same thing, why dilute yourself? Or why raise that much money? Why go through that pain? And so I think one of the things I try and get founders to think about is capital efficiency is a good aspiration to a degree. So I think number one, evaluations don't matter. It's how much you actually need. Second thing is you have to be realistic of where you live and where you're hiring. And the reality is it's set by the market. So the lead sets it. And then the third thing is if you're raising less than, let's call it 3 million, 2 to 3 million range, trying to raise a pre-seed C round from overseas investors where you don't base there is so hard.
It's really hard.
And so my view would be like, if you live over there, if you live in the US or Europe, then that's, then fine, raise from those investors. But the reality is if you live in Australia, don't worry about too much what the valuations are. Keep it in mind, but the reality is, you're building in the context of Australia.
Yeah, I mean, ultimately, particularly in the early stage, everyone is hoping for a, 10,000x uplift,
correct.
Including you.
Yeah, correct.
Right?
Correct.
Like that's what we're all hoping to do, and that's our business model, right? Our business model isn't to do a 2 times return and then flip it and like add some interest or whatever along the way. Like
that's right.
Our business model here is like home runs.
And there's tons of examples of startups and pre-seed companies starting in Australia at very sensible valuations and then growing quickly and then raising from overseas investors, mostly US, that then pump the valuation up more. And I think the reality for founders, though, is the more the valuation gets frothier and frothier, the more they have to grow into them.
Yeah.
And that means the faster they have to grow. And so
if we look at the story of the last 12 months, you look at the fact that 30+% of the workforce has been just like cut.
Yeah.
Like that's what happens when that growth story slows down.
That's right. So I think frothy pre-seed seed valuations is generally not a good thing. I try and encourage founders not to aspire to be the frothy valuation. Competitive rounds are good.
Always.
Competitive rounds are good for the founders. For the investors, it makes it harder for us. But, that's the game we play. And that's our view on valuations. If you've got any thoughts or comments, send them our way. I'm very happy to hear. Cool. Should we move on?
Sure.
All right. Okay. Moving on to our favorite part of the podcast, and apparently your favorite part of the podcast too. We are going to roast my deck.
I still need a little soundboard to be able to do sound effects.
I'm going to set the scene with this particular startup before we get going.
Sure.
This particular startup is unique for us because we're sharing a startup that we have now invested in. We can't disclose any details about the investment because it hasn't been announced. All I can say is that Galileo's invested, so we've redacted some of these things. But the reason why I wanted to show it is, one, it's an AI deck.
Yep.
Two, it's pre-seed, so very early.
Yep.
And three, we invested, and the deck we thought was very clear and came across.
And it's a deal we did, I guess.
Yeah.
It's also, I think, good to sometimes be like, hey, this is a deck that we were like, hey, we ended up doing a deal from this.
Correct. So that's sort of the caveats sitting across, and that's why we want to show.
And the founder said it was fine for us to share the deck in a redacted format, just to be clear. So if you'd like to get your deck roasted, send it in to James.
Send it in to us.
We can do some light redactions as appropriate like this if that's what you would like. But anytime.
Moving on, let's start with slide 1. Hugh.
Hate it.
Okay. I thought you liked this slide.
No. So actually, it's fine. The part I don't like about it is it doesn't tell me what you are. I think the first slide needs to include that piece of what does the business do?
True. We've said this before. It really should. Yeah. It is very blank on.
Because again, this is the little icon you see in my little CRM and my email and everything else. And I want to be able to see in the thing, the name of the business.
Yeah.
But also what it does.
Yeah, I don't disagree with that part. Cool.
Otherwise, sure.
Okay, slide 2.
So you could have put that title in the previous slide, and that would have been great. So, I actually I think a nice, simple, short, a little bit wordy, I think, in some ways, but I don't mind it. It sort of is, easy to read and things like that. It worries me a bit, sort of we're talking about true state and another thing called dawn, and I'm like, what's dawn? What's true state? It's a bit of jargon already starting to come up. And then the second part of me goes, okay, so enterprise adoption of generative AI, what does that mean?
Yeah.
What are we calling generative AI? Are we talking about, e-com companies producing pictures?
Yeah.
Are we talking about, Adobe making blog posts? Are we talking about, I don't know.
So the thing that resonated with me, and for those just listening along, enabling enterprise adoption of generative AI is the main header here. That's the main thing for me. So I'm like, okay, great. The enterprise company focusing on enterprise solutions for Gen AI. 90% of the decks we see in this space are usually around quasi prosumer consumer Gen AI adoption.
Or SMB SaaS.
Yeah, SMB SaaS. For me, heavy enterprise, I'm always interested. So that's kind of what grabbed my attention. I kind of agree with the product names and things like that started to get confusing. I'll move on to slide 3.
Yep.
Slide 3.
Now, busy slide.
Don't mind it.
I don't mind it, but it is busy.
It is busy. True State is building for a debundled future now, where enterprises train and run their own AI models across all use cases to capture value.
Right now, to be fair, now this kind of comes back to the question of religion, right? This one here is do you think that in the future, as an enterprise or as a business, you'll be procuring a single vendor to have many, point solution AI solutions within the space, or will you have one for this, one for that, one for this, one for that, right? And this obviously says, okay, well, the thesis they're going after is you're going to have one solution and then you're going to build your own internal vertical enterprise solutions. rather than buying 10 different true steps.
Yep.
So I actually like that it makes that piece clear.
Yep.
That's their kind of like perspective on what the future looks like.
I agree.
Because that also turns out is what we think.
And to add in, there's very, very good use. There's no titles that says solution. It just says there's a lead-in title, which is the main point that wants to ring. So it's very easy to read really quickly. So I think that's plus tick. I like that there's 3 key indicators, not like 10.
Yeah.
And I like that he's given some really simple but not particularly great example use cases, I would say.
Yeah. So, I mean, I think the key indicators, again, like from reading the title, it's like, cool, I've already come up, I already have a view on that point of religion. So I don't really need to care about the key indicators. We have our own view on what, why that drives that way.
Yep.
I agree with you that the use cases here, I'm kind of like, like the copywriting use case is a particularly painful one because it's just too
generic.
It's the low-hanging fruit.
It's generic, and it's also been done.
Yeah,
there's already a company generating over 110 million in ARR doing copywriting stuff, and
so I think it would be more impressive to me if talking about those use cases where either it's more specific to being like, hey, like this is what a manufacturing brand might do or a pharmaceutical brand might do or whatever.
I agree with that.
This is how they would approach that, rather than these sort of broader examples. But they're kind of much more. You could put that in again using my test of could you put any AI company's logo on this and say, here are some use cases. I go,
there's obviously tons, which was a disservice because when we actually did the first call, he had some really specific prototypes. Cool. So this is for people watching or listening, the interesting thing about this is already starting to set the thesis about their worldview, which in AI investing circles is not always agreed upon right now because we don't know where the market's going to land in a lot of situations. We'll move on to slide 4.
Very similar to the previous slide.
Yes, it is.
In terms of visual.
Yeah. Understanding and building for enterprise requirements is a condition for success in a competitive US $3.6 billion market. Hugh, what do you think?
3.6 billion, too small.
Yeah, that's like
you're leading with a TAM that's way too small.
Yeah, wildly underestimating.
You're like AI solutions for enterprise, 3.6 billion. I'm
pretty sure Microsoft's latest quarter call just said they added, I think, 5 or 6 billion to their top line for AI.
No, 5 or 6, but like
it's some ridiculous number. But either way,
again, like I think, and perhaps the footnote and things might be able to explain. Like it's obviously a bottoms up calculation, but like I think it that probably undersells the market size. So if this is meant to be telling me about the market size, I go, okay, that's not really very helpful.
It does, but what I did like is he straight away started and then put in a footnote, right?
How he's calculated it.
Of how he's calculated it.
Yeah.
And so as an investor, I actually really like that because then I can go, do I agree with that calculation?
Yeah.
In this case,
it's not just a magical number you pulled out of your...
In this case, it's a really easy footnote to understand. Yeah. And I think it's a great footnote. And I think, that's fine for now. It's a pre-seed deck. I think he's underestimating.
Market sizing isn't necessarily a pre-seed problem.
That's
as long as we, again, as an early stage VC, we want to be able to look at this and go, if I squint at this, will it get really big?
Correct.
Right? And I'm like, generative AI for enterprise, it'll get really big. If this company wins and things go well, the company will get really big. I don't really need to be told it's a $3.6 billion market. And you're like,
yeah, I don't. But having said that, I don't mind the bottom-up calculation part, and that's fine.
I actually like better the rest of the slide because the rest of the slide shows me the insight on why he's building this company. Right, and the left part of the slide talks about the enterprise requirements for analytics tools. So now we're talking about analytics. And he's talking about what it looks like in terms of end user, usability, data security issues, all that kind of stuff. And the right-hand side talks about essentially the procurement process, right? So like how a large enterprise procures a technical solution, which is these architecture review boards, right? And that says to me, oh, look, okay, so this founder obviously understands that enterprise world.
That's right.
He wants to build the thing for enterprise, and he's showing here in this slide
that
he understands the requirements, he understands what it's going to probably be like to actually get this into the hands of people.
That's right. In fact, I would say that whole right slide section to me is what I would call sort of, founder insight, customer insight. And on top of that, I like it because every deck I've seen to date, no one has mentioned this group of people.
Yeah, I mean,
a lot of the decks.
It's just a wanky version of saying it runs a tender process.
But Sure, but nonetheless, none of them sort of address.
I mean, to be fair, the number of enterprise SaaS solutions that we see that don't seem to understand what it is, but to be part of a tender process is a
large number
problem.
Yeah. Okay, slide 5, team founder profile.
Ooh, solo founder, right? So this is the moment that you go, ooh, and as we say, no, nothing is ever a hard no for a VC.
Yeah.
But solo founder always risky.
Yeah.
Always risky. But I actually I like the slide barring that. Obviously, like solo founding. But I like the slide other than that. Talks about being ex-McKinsey, private equity. I'm like, okay, cool. That's where obviously the enterprise experiences come from.
Yep.
From the McKinsey and PE type world stuff.
That's right.
And then goes into a bit of detail about the technical experience and things like that. And I'm like, okay, cool.
Yep. I think it's a great slide. So for founders watching and looking at it, I think it shows relevant experience and it shows why it's good and it explains it. But of course, it is a sole founder and that does put off a lot of
What
investors.
I would like in this though is a LinkedIn link.
Sure.
No,
I mean, I don't disagree.
That's often nice in these slides because sometimes, particularly if it's the ones where there's like 4 or 5 people and there's just like 3 logos and one sort of summary of what they've done in the past. You're like, oh, okay, like they reckon they used to work at Google. What do they do? Okay, and you click through the LinkedIn, which is nice sometimes to be able to do. Otherwise, I have to Google it.
A little plug for TrueState. They are hiring, so if it sounds interesting, you can. His email's right up there.
Always
so
be
you
closing.
can email him exactly. Okay, moving on to slide 6, which is essentially the product slide.
Yeah, so quite late to really be bringing in the product, but I like the fact that it's got the words working MVP, so it tells us what stage the thing's at, right?
That's right, yeah.
Quite clearly. And it's got some sort of screenshot, which also says to me, they've got some degree of user interview.
Small little tidbit, the screenshot is a real screenshot of the MVP, not a mock-up of a thing that doesn't exist.
Yeah, exactly.
That won't exist for 3 years or whatever. It's actually just like, this is what the raw MVP looks like, and I like that.
And I like the workflow piece at the bottom. I think that's really great. I'm not sure that the enterprise grade data security thing needs to be repeated on the right. I feel like we've already kind of covered this multiple times in the slide. I think a different differentiator could have been better put there. Again, I think the affordable pricing piece, I go, okay, sure. Like, again, it's footnoted with some descriptions and stuff like that. And I go, okay. But like, I actually think that the advantage of these kind of things is actually saying, being vendor neutral in terms of the underlying models enables, enterprises to be able to pick the best model for the best use case, the best workload.
Yeah,
and I think that doesn't really come through here. Like, talk about the seamless deployment, yes, stuff, but like, I also think that like the benefit that you're trying to bring to the enterprise is also that independence piece.
That's right. It's being able to deploy open source,
as compared to, we've only ever got to buy, the AWS model.
That's right. Yeah. I think bringing the open source and the model selection is really important, even though obviously we're still in early days. But one of the reasons why we invested was the fact that you can choose models, and hopefully down the line we'll have fine-tuned models for various aspects as well. That you can pick and choose to use.
My only other criticism of the whole Dawn TrueState thing, again, like
unnecessary.
Yeah, unnecessary.
I don't think you should
just call the first thing TrueState.
Yeah, exactly.
If the next product is going to be called Dawn, call it Dawn. It doesn't matter.
Yeah, I agree. Okay, slide 7.
Okay, so this is how we're going to generate moat.
Yeah,
I like that.
Yeah,
right.
It's actually quite refreshing to see. Most pre-seed decks have nothing to do with competitive advantage. Just don't even mention it.
Yeah,
I mean, they don't have any because they're pre-seed, but like they don't. I like to know when the founders are thinking about it.
But I think the other part that I like about this is that it talks about the way that the founder sees the horizons.
Yes,
right?
correct.
Where it's like, Horizon 1 is kind of just like UX, make this easy to do.
Yep.
And that's not really long-term defensible, but you know what? Short-term, quite possible. Like a lot of this stuff is still stuck in the command line.
Yeah.
Phase 2 is that data piece. Like a lot of startups just pitch you that phase 2, 3 model without really recognizing the piece of that might be a long-term moat, but is very hard to sort of then become a short-term piece as well.
Yeah.
And so I think I really like that way that he's sort of thought and laid out about that piece of how it's segmented.
Yeah, I agree. I think this is a good slide. And then slide 8, we're getting to the end of the deck.
Slide.
The ask slide. This is where they ask for money.
So dollar size.
Yeah.
To grow the team. Again, what they're going to do.
Yep.
What's missing from this slide? Pie chart. Love a good pie chart. Use of funds.
I don't think you need a pie chart.
I like a pie chart for the use of funds. Again, like I can see a little bit of that because he's talking about in the ideal talent profiles. He's like, okay, cool. He's got 200 engineer. Obviously, he's going to do R&D, but also going to hire sales early. I think that's a good, good sign for an enterprise company.
Yeah.
Even though early sales will always be founder sales, but we'll put that piece aside.
Yeah.
And then talks about the milestones again. I like that too.
Yeah.
And I think from memory there were some dollar value targets in there.
Yeah, there was, but we had to take them all out.
Which have obviously redacted out. But again, gives us a good insight into what are the actual milestones the founder is expecting to meet before that next seed phase, and how much does that line up with what we would think a company like this would do?
Yeah, I agree.
Which speaks to the sophistication of understanding how well the founder understands the VC business model and the way that these businesses stack up.
Look, I think my only points to highlight, apart from what you just do, is I'll sort of add the fact that you put 2 key hires there is really important. And because you're a founder, solo founder in this case, I think putting the key hires is even more important, because one of the big risks that me as investors go, can you hire that team?
Yep.
Having now invested...
And you're aware of your own limitations.
Yeah, correct. And I think that's really important, because no one wants to invest in a solo founder business. We're here to invest in people that can build really, really high profile teams, high performance teams. So I think overall, not a bad slide. I think generally it's quite good. The milestone piece is good too.
Yeah. It'd be nicer in a little timeline slide, but again, that's stylistic, which we're not getting into the stylistic piece.
And that's really it. That's slide 9. So the nice thing is less than 10 slides.
Yep.
Very clear.
Really 8 slides of content.
Really 8 slides.
7 if you exclude the title as well.
Correct. It got all the major points. We even talked about moat, which very rarely they don't. There are a little bit of words, but that's okay. It's fine. It's just the style.
We read through the words.
And I think overall it's very good. What would you rate this deck out of 5?
I'd give this a 4. One day I'll either give something a 5 or a 0.
I'm going to give it 4.5 stars.
Okay.
4.5
I agree.
stars.
It's definitely one of the better decks that we've seen.
Yeah.
And to be clear, I think, and for the listeners, right, this isn't one of the better decks we've seen because of its design, because of its layout, because it's that stuff. But as you've seen us talk through, it's actually just the way that it's well thought out. It helps us to understand the questions that we're asking as we're reading through the deck, and it makes us interested to learn more.
Yeah, correct.
And that's really the point of the deck, right?
Correct, that's right.
The point of the deck is to make us interested to actually come and talk to you and learn more.
Yeah.
So that we can then go, oh, this is really exciting.
That's right. So for those listening and watching, we did do follow-up conversations. We did end up investing. If you want to know why, we'll release that in due course. You can sign up to our newsletter on our website, galileo.ventures, and you'll be the first to hear about it. In other news, I believe that is it for us.
That's it.
For episode 5, that is it. If you send your comments through, if you're listening on Spotify, super easy. You can respond on the app inside the app.
At those?
I do.
Okay,
they come to me. If you're not using Spotify and you just want to email
only
us...
negative compliments in the Spotify box, please.
Thanks.
Positive compliments to my email address.
Yeah, that's right, yeah. If you want to email us, the best one is just our team email, because we both see that. Everyone in the team sees that. It's just team@galileo.ventures. And if you are just seeing us for the first time, welcome. Please like and subscribe. We're mainly on Spotify and YouTube, but you can listen to us on Apple Podcasts, and over time we'll sort of add the other ones as well. And apart from that, keep an eye out for the next episode, and we'll see you next time.
Awesome. See you next time.